Welcome back to NYSE TV Live. Well, despite Moody's lowering the U.S. credit rating late Friday, the major indices started the week in the green with the S&P 500 booking its sixth straight winning session. Joining me now with more in terms of what investors can expect is Bob Iaccino. He's a co-founder at Path Trading Partners. Bob, great to see you this morning. Joining us, I'm sure, from sunny Florida, down there in Naples. And look, the last time we spoke, we were in the midst of some serious volatility as it pertained to tariffs. Fast forward multiple weeks, where do we stand now in the markets?
Well, good morning, Kristen. It's good to see you again. Yeah, I am still in sunny Florida. It's pretty sunny behind me, although I got my nice brick wall to block that. I think when you're looking at that volatility from the last time I talked to you, I wouldn't say goodbye to it entirely. There are too many moving parts, and you kind of caught me at a time where my view is evolving, and it's mostly due to some conflicting economic data. We had the Philly Fed Manufacturing Index. We all know the president is talking about bringing manufacturing back to the U.S. I don't know how realistic that is from a macro perspective, but the Philly Fed Index seems to be thinking, at least in that region of the country, that could happen. It's moving in a very optimistic direction. Their prices paid actually was even concerning, moving from up into this 56, 57 area with 5 straight consecutive months of their prices paid going higher. And the interesting thing about that component of all the different PMI numbers that we get and indexes that we get, Philly Fed's prices paid correlates very well to consumer inflation with about a 3 to 6 month lag. So that's concerning. Labor costs are still too high to completely think that inflation is dead. And I think that's part of the reason we're seeing people like New York Fed President John Williams, Minneapolis Fed President Neil Kashkari, Atlanta Fed President Raphael Bostic, talking about fewer rate cuts than the market is currently pricing in, and talking about having to wait and see what's happening. So it may not just be tariffs. And again, if you look at tariffs, if we get tariffs sustained at where they are, that's mostly a one-time price hike. It's not really a driver of ongoing over the Fed's target inflation. So it would be more one-time price hikes, and most components are built overseas with a lot of products being assembled here. So it's not even the full effect onto the price of the finished good that goes to the consumer. On top of that, we had a 13% move in the S&P over the last 21 sessions. That's 2 standard deviations. And looking at that kind of a move over such a short period of time, forward returns, and I'm talking 6 to 12 months from now, are very, very good.
Interesting. So, Bob, when we had last spoken, just around the reciprocal tariff date, you had mentioned that you think there will be a once-in-a-generation buying opportunity. Has that window passed?
So this bothers me from a perspective of what I just said about the S&P and the 13% move. That indicates that the bottom is in, and it's statistically significant when you look at the data. But what bothers me is if we're getting a multi-decade bull market, which I think we will go into, this bottom doesn't matter, because you're looking at maybe 10, 15 years of increased prices in equities. So getting the exact bottom is going to be statistically insignificant. So I wouldn't worry if you missed it at this point. I think we'll see one more downdraft if that was the bottom that we saw in March. I think you'll be seeing maybe a move down to 5,600 in the S&P, somewhere in that range, and you could pick it up there. Or you can just wait till new all-time highs, because when you look at the person who bought the bottom versus the person who buys new all-time highs, 5, 7, 10 years from now, not much of a difference.
Interesting. So in terms of looking at a holistic portfolio, Bob, if someone does want to enter the market now, or they just need to readjust maybe what their actual holdings are, what is a framework and some perhaps sectors and or specific stocks that you think are attractive?
Well, specifically, full disclosure, I bought Rigetti Computing yesterday. Now, that's me. That's not clients. It's not friends and family. So before I say this, I need people to know that I did buy that yesterday. But I like quantum computing as a micro sector, because I think that's going to be sort of the next new wave. It's the kind of thing I'm looking to hold for about 5, 7 years to find out if I'm wrong, not 5, 7 days. Now, most of the time when I'm talking about equities, my average hold time is about 26 days because I am an active investor. So looking at it from that perspective, I do like Home Depot. I like Lowe's as well, which we know reports in the next 24 hours. I also like sectors like banking because of the shift in the yield curve, which we saw even after the Moody's downgrade. The actual overall rise didn't really sustain in the yield side of things, but we do have the 2-year down 1 basis points and the 30-year up 3 from that Moody's downgrade. So that's that shift that helps banks when you go to a steepening yield curve. So overall, I like those sectors. I actually long-term like energy, but don't like it right now. And then lastly, I almost always like gold. Not necessarily my entire career, but over the last 4 to 5 years and over the following 5 to 10 years, I think gold is a major component for a diversified portfolio because of its non-correlation to equities, number one. And number two, it does have periods of time where it moves in the same directions as equities do. It has a positive correlation over stretches. I think that stretch is still coming.
Interesting. You mentioned Home Depot, that stock at a quick reference of 2.8% pre-market, of course, after earnings this morning, reaffirming its full year guidance. Bob, I do want to ask you about how the Fed factors into all of this, because you mentioned some conflicting economic data, and the Fed chair we've heard so far is ready to be patient when it comes to the path forward on borrowing costs. How does that factor in to stocks movement?
So the CME Fed Watch tool shows 4 rate cuts through 2026 already priced in. Not at super high probabilities, but priced in. That's from 5. And then prior to that, we had 6. So the move toward fewer rate cuts has been climbing into the market slowly but surely, even while Fed speakers, as I already mentioned, continue to point to patience and pausing to see, number one, how tariffs play out, but number two, how these conflicting economic signals resolve themselves. My personal feeling is they resolve higher or better for equities, which would be fewer rate cuts if the economic data is showing strength. So I think they're on pause. I really do. And I think they're trying to tell us that markets aren't quite listening yet.
All right. Bob Iaccino, co-founder at Path Trading Partners. He's going to rejoin us after this market opens for that real-time pulse. Bob, we'll see you soon. Well, I do want to re-welcome our guest that we were speaking to before the bell. Now that the market has officially opened, Bob Iaccino, he's a co-founder of Path Trading Partners, rejoining me remotely this morning from Naples, Florida. And as we see a breather, Bob, anything that investors should be concerned about?
Concern, no. I'm not worried about this price action I see right now at all. I'll give you an example. We bought a stock about, let's call it 3 weeks ago, Walmart. We bought it right below about $90 a share, and it's opening up about 0.3%, pulling back to fill a gap. Completely comfortable with that. When you look at a stock like Walmart, who announced that tariff price hikes are coming, investors still want to be in this particular name. So I like that kind of price action because I think that overall the market believes that tariffs are going to either resolve themselves completely or resolve themselves lower. You get a little bit of pressure like this. We saw yesterday, it's difficult for the market to go on its back foot. And even if it does, I think if the S&P gets down to about 5,600, it's probably a buy. And that's the kind of thing that I'm looking for to actually add to positions.
Bitcoin back above 400,000, 104,000 roughly per Bitcoin. Bob, is that something that you find attractive here at these levels? I know you were speaking about gold just before the market opened.
Yeah, currently I use proxies for Bitcoin. And to be honest, Kristen, I don't even know why. I think it has to do with my my sort of appreciation and affiliation with gold as an asset class over Bitcoin. But I do trade Bitcoin by using stocks like Coinbase, even to sometimes MicroStrategy. I use those stocks when I think I'm going to get a move in Bitcoin. Part of it is my sort of uncomfortable old school nature with things like cold wallets. I had a friend who had lost his cold wallet in the fires in California and lost the Bitcoin that was in it because he didn't have it properly backed up. I'm not skilled enough to know how to back those things up. And I think that's one of the problems Bitcoin still has. It still has too high of an upside correlation to NASDAQ. It's losing it, but it's still too high in my view, where gold is a completely non-correlated asset with equities.
Interesting. Anything else our viewers should know about Bob now that we do see the market open? And again, just a bit of a breather here today after what's been a very strong run.
You know, you had your shopping expert on, Trey Bodge, I think her name was. I hope I'm pronouncing that correctly.
Yep.
She said some brilliant things in my view. Is that shoppers and consumers are getting a lot smarter, and that's helping consumers to continue to spend. Another stock that we currently own, full disclosure, Shopify. I think that's another way to kind of protect yourself from some of the things that may happen. But I wouldn't get too tied up in thinking about what tariffs may do to the market. You're sort of then advancing your fear from the future into the present, and I never think that's a very good strategy.
Bob Iaccino, co-founder of Pack Trading Partners. Bob, thanks so much for joining.
Good to see you.
Good to see you.